This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options trading program. And let's go into Market Mondays for 6/7/2021. And to kind of repeat, if you haven't been here before, if you don't know about the show, I want to ask you to like, share, subscribe, let somebody know about it. The reason why we put this little broadcast on is because we want to give you a really quick market-based analysis. Do it in a common tongue. We want to kind of get away from the idea that you need to have a PhD and some type of financial background. You need to have a PhD in economics or mathematics or business to be able to talk about the markets, or you need to be one of those people on those particular market-based shows in a suit. And we're kind of seeing that transition starting to change, right? Where more and more people are coming to the market and understanding the benefits of the market that are just regular people, and stop believing that you got to talk to this person that's high up on a hill to understand the markets, right? And so what we want to do is really give this information to you, make it succinct. We don't want to keep you here a long period of time. We understand that everybody's busy. People got things they want to do. So we want to, give this to you, have you get something from it, give you something that you could talk about and understand, like how understanding the market and being in the markets can benefit you and your family and where you're trying to go. And let's get on to the next scenario. So let's go ahead and start the broadcast off. So today is 6/7/2021. It's Monday. And what we saw was that the S&P was down around 0.08. Dow was down around 0.36. NASDAQ up around 0.49. The 10-year treasury is around 1.57. That's starting to become less and less relevant over time, even though we keep tracking it. And the CPI data is coming out later this week. And I heard that Powell was supposed to be speaking on Friday, but I couldn't actually confirm that. I couldn't find out where that was actually going to be reported. What we saw last night is that the futures market last night was red. I saw that before I went to bed. Woke up this morning and it seemed to be green for the most part. But it seems like as soon as the market opened, it turned red. And so what we're kind of seeing is that there's a little bit of volatility in the market. And the market, to me, really doesn't have a real direction yet. It's still fairly choppy. What happened last year, because the market was under so much stress because of COVID, I think that, and then it started turning around and become very bullish. I just think a lot of us still are not used to the choppiness in the market yet, because what we saw was that it had a really bearish direction, then it turned around and went really bullish. Then we had maybe a month of September where it was bearish. Then it turned right around late in the year and became very bullish again. So I think the choppiness is still throwing people off because they're expecting a direction, and it's hard to trade without a really solid direction unless you really understand intraday trading really well, or else you're able to take a position and sit in it for a very long period of time. And then also for a lot of people who are trying to do buy and hold, but they like to look at their account on a regular basis when the market goes red, but they say they're doing buy and hold and they're looking at their account. Right. So the choppiness has a lot of people uneasy, and we got to try to figure out, are we going to take a certain direction for any extended period of time? Let's say maybe a few weeks or a month, or are we just going to keep having this choppiness in the market? Now we're going to talk about jump outs. So we're going to kind of talk about companies that either did well or did not do well and kind of give you some context. So Upwork was around 0.6% today. This is what some people call a freelancer site. Some people call it a work from home site. We started seeing them do really well late in the year as they started reporting numbers post-COVID, right? And so a lot of people are very bullish on this company long term because they believe that this particular space is only going to get more and more valuable to people as they look to work from home and try to figure out this is like a at-home version of the gig economy. And so that's something that we want to talk about today. We look at Visa. Visa got an upgrade this morning, and we saw on the chart they came out really strong, and then they just really sold off, right? That's very interesting. I would want to look at that chart a little bit deeper, kind of maybe understand the volume. But for some reason, people saw this as an opportunity to take profit. Maybe they're going to reposition at a later date. However, the upgrade was the fact that as the market starts to recover, more and more people are going to start utilizing Visa. And they believe that Visa might be a little bit better positioned to take advantage of the change than MasterCard. I know a lot of people are really big on the Squares and the PayPals and the Stripes. But Visa and MasterCards are still major players in the transaction processing space. So I wouldn't disregard them, even though I know a lot of people are looking for the latest quote unquote tech improvement. But Visa and MasterCard are who they are for a reason. So I don't think they can be disregarded for a company that has a lot less of a track record and is not as entrenched in the payment transaction processing game. Now let's look at NEO. NEO was up today, and we saw NEO historically hit around $60. It sold off since then, and we're trying to see is it maybe making a little bit of recovery. And one of the things that we saw was that oil is up, right? And I think that oil being up is going to push money into EV, because what oil does a lot of times is oil becomes more expensive. People look for alternatives to oil, and essentially, like, regular oil drilling, that becomes very expensive. What people now start to do is look for like shale oil, or they look for methane, they look for coal. And I think what we're going to see is that a lot of people are going to now justify the EV space as long as oil stays elevated. I think if the oil goes down, I think the EV space also goes down with it. And so the whole argument for EV, right, electronic vehicle space, is based on, fossil fuels. So, but if fossil fuels become relatively inexpensive, and they become really, really easy for people to access, the demand for EV is going to fall away. So there's going to be a direct relationship, a direct correlation between the value of each sector based on which one is high or which one is low at that particular time. I think if EV space becomes too expensive, I think people are going to run back to internal combustion engines. So I really want to continue to observe that, to try to figure out over time, once we start to really build out this EV space, it starts to become a little bit more robust. We get some track records with it, especially from a sales standpoint. Can we start to see the type of correlation between those two particular spaces? Because I'm not one of those people that believe in 5 years or even maybe 10 years, internal combustion engine cars and automobiles are going to be totally null and void and everybody's going to be driving around in an EV car. I don't necessarily believe that. Now let's talk about the substitution effect. Now this is something that's one of the kind of like fundamentals of economics. I'm a big believer that they should probably teach economics on a fundamental, teach probably macro or microeconomics on a fundamental level, K through 12. There's a reason why they don't do that. I don't want to get into that because that's not really the topic of this particular presentation. However, what we're going to talk about is a substitution effect. This is kind of like one of the basic fundamentals of economics. And once you kind of understand this, you can start to understand consumer behavior. Once you start to understand that, you can kind of understand what's going on inside the market. So here's a basic example of the substitution effect. Let's say I eat beef. I'm a big beef eater. And I go to the store to buy like some steaks. And I believe that the steaks are too expensive based on my demand or desire for the steak. So then what I do is I say, well, let me go buy some chicken. And so let's say for the next few weeks, beef stays elevated. So I just keep buying chicken. And then let's say hypothetically, we get such a strong demand for chicken, right, that now the price of chicken starts to go up because, they're going to essentially fill that particular demand with supply. And then now everybody's buying chicken. So then what I do now is I go and get pork. And then, I eat pork as a result of beef and chicken being too expensive. Then let's say hypothetically everybody runs out of pork because the other two are too expensive. Then what will happen is the sales of beef and chicken will drop off. They will now become less expensive. Pork will become more expensive because everybody's eating it. And then we go back to beef and the cycle starts all over again. So what you see with the substitution effect is that when you're dealing with a particular item that a person wants, or there's demand for the item, once the price gets higher, we believe that people will move to another item that gets them the same satisfaction, but at a lower price point, right? And then, we get a little complicated. We start talking about inelastic and elastic, pricing. But from just a basic standpoint, if I'm going to the store to get beef and beef is too expensive, and I believe beef is too expensive, I start looking for substitutions for beef. Okay. And so this is why I think the alternative meat space is going to have challenges, and Beyond Beef and Impossible are not new. If you go to your frozen food section, there's a whole section of frozen foods in which they sell like alternative meats, soy-based meats, things of that nature. So they're not anything new. They've been around for a very long time. But what you got to understand is that normally these particular producers and these really like the lobbies for these particular producers, because I think, have you ever seen the pork is the new white meat ad campaign that's put out by pork producers? You got the beef campaign, and you also got, I don't think I've ever seen a chicken campaign, but I know I've seen campaigns for beef and pork. Those are put out by producers in that particular area. They all form a lobby, and they decide to pretty much promote their industry and make sure that their industry stays viable. When you're looking at these particular industries, there's something else in economics called pure competition. And some of these industries, I'm not sure, but we do have industries in America similar to dairy. And also, I'm not sure about eggs, but I believe dairy, they also get subsidized. So I don't want to get too complicated with it, but I want you to understand is that when a particular industry, they believe that the increase in pricing will harm their industry, they will often try to do something to stop that. So then what they will do is say, well, maybe let's produce less to get the price to go back down, because they do understand the substitution effect. And so they understand that if beef becomes too high, people won't buy beef just because they want it, because they can't afford it, or they will buy it less, which will hurt our sales. So if we start to see that the cost of beef is becoming too high to our end consumer, what we will do is we will throttle production. And by throttling production, then what you'll have is that there will be a lag in, access to beef from the packers or the actual people that process it. Then that's going to hit the supermarket. And then what'll happen is the price of beef will start to go up a little bit, and then it'll modify people's behavior. Or we will increase production, make the price of beef become less expensive at the end consumer, and then we can make sure that they continue their consumption of beef. So, when you're dealing with a cattleman, a real cattleman, they got their numbers down cold, because they understand that this is a numbers game at the end of the day to the consumer. The consumer has a certain amount of money in their pocket that they can spend for food. And if your price of your food gets outside of their range, they're going to go to something else because it's available. One thing about the United States of America, in most places of America, food is readily available. So you very much have to worry about the substitution effect in your pricing, right? Especially with food, because food in this country, we've been very, very blessed in this country to have an abundance of food. We almost got too much food. So people very much deal with the substitution effect, especially in regards to food. In other places, they're willing to pay the cost. But when it comes to food, people very much will price shop based on the amount of money they have in their pocket. So now, as a trader or as an investor, if you see that there's maybe a shortage in a particular area that's going to affect the consumer, you want to start asking yourself, what would they substitute that with? Especially when we start talking about how now the market is going more towards what they call cyclicals, going more towards different areas of the market that are maybe seasonal, going towards different areas of the market in which they're what I call more the boring plays, that are not as exciting as the quote unquote tech plays, but are kind of like the plays in which the essentials, right? If these particular things become more expensive, what would they substitute them out with? So if I'm looking at a particular area of the market, and I believe that, because of what's going on in this particular area of the market, it's going to raise the cost of them actually getting this product to their end consumer. Well, maybe there's another area of the market, right, where the consumer is going to substitute in regards to that. And then maybe I need to put my money over there. Another thing that you want to observe when you start talking about people trading in and out of particular positions, to me, we still get the same substitution effect, even though normally it's explained from a consumer standpoint. When you're looking at a particular company, as a trader, right? And the majority of people in the market that are doing the daily activity are traders, right? The long-term people, the big institutions, the big funds, a lot of times they take a position, they sit in it for a longer period of time. So when we look at somebody like Kathy Wood, she's explained that when she's in a particular trade or she's in a position, once that position hits a certain price point, she trades out of it. Why? Because she believes that it's going to be too expensive to continue to add on at this price point. And she looks for other place to put her money. So if she believes that I'm in this particular scenario, I'm in this particular ticker, and that price point becomes too high, it is now too expensive to add on. So now what do? I'll substitute that with another ticker. So I sell out of that position, I add on to another position that I believe is more appropriately priced. And then what I do is I anticipate that is going to also go up. And then what do then? I'll sell out of that and I add into another position. So we see the substitution effect all across the actual economy, and we see it in different areas. So I want you to start observing this first in your behavior, right? If you're going to the store and you have a desire to buy something, do you say, well, you know what? That's too expensive. Let me go buy this instead. Or do you just try to find a reason to buy it, right? Or do you buy less of it? So, the way in which you can really start to understand some of the fundamentals of economics is you can look at your own behavior. You don't need these weird examples. You just look at your own behavior because you're involved in the economy every day. So, you don't need to be thinking about, examples that are outside of you, because you're the actual example. And if you start to observe your own behavior in the marketplace, you'll start to understand some of these basic market principles, and then you can start to transfer them on a macro level. So look at yourself as a micro example. Then you can start to, kind of forecast what you think other people are going to do, because the whole market is based on human behavior. Even though algorithms are involved, the algorithms are programmed by humans. So the actual structure or the system is based on the psychology of the actual person. So every system is based on the psychology of the people that make the system. So even then, human behavior still impacts what goes on. So that's going to be the substitution effect. Hope it wasn't too convoluted. Hope it was kind of basic and direct as far as trying to get you to understand that and how to apply that to your trading, but also your long-term investing. This is David W. Williams, also known as Diamond Dave. If you have any questions, hit me up in the comments. If you want to learn more about the highest paid part-time job in the world, the link will be in the description of the video. We also have the VIP course with the one-on-one consultant, the mindset coach, the one-on-one for the trading plan, and probably about, I don't know, maybe 7 or 8 more videos than the actual core course at a higher price point. Most importantly, because of the time of the people that are involved. You can hit me up about that. It's going to be for serious people only. If you have any questions, let me know. This will be David W. Williams. I'll talk to you later.